Welcome to the buy, hold, sell thematic discussion. I'm Matthew Kidman, and inflation. The kryptonite of markets is back. What should happen when you have inflation? Bond yields should go up. Guess what? They haven't. Who knows what's going on? It's confusing, we know. And to discuss it today and what it means for equity markets, we've got Ben Clark from TMS Capital and Justin Braitling from Watermark. Welcome, gentlemen. Ben, I'll start with you. What's going on out there? The 10-year yield on the 10-year bond from the US is actually heading down instead of up, and we've got inflation.
Yeah, it's definitely been an unusual few weeks, Matthew. Inflation continues to print higher than expected. It feels like central banks, particularly the Fed, are starting to soften investors up, that rates will move a bit earlier than expected. The bond market yields, as you said, have contracted. And I think what the bond market is telling us is that there will be a short-term normalization in interest rates, but it's not a structural change into a much higher rate environment. And, maybe bond markets sort of actually overshot themselves at the start of the year when they were worrying about this more. Okay,
Justin. So we've got inflation. We've been smacked with a hard data point out of the US, and we've had the Federal Reserve tell us that it's got on top of us a bit quicker than they thought. But as we just mentioned then, what Ben said, the 10-year bond yields come back down. Is inflation transitory, or is it here longer and the bond market's got it wrong and we've got to rethink it?
Well, I think we're seeing a reversal in these reflation signals, and it's a pretty strong message coming from across the capital market structure. We would like to look at not just bond markets, but bonds, equities, and currencies. And typically what happens in the reflation, when economies reflate, there's a move out of the safety assets of bonds and the US dollar into risk assets, and equities are the pointy end of risk assets, but commodities as well. So we've seen that for the last 12 months. And then what we've seen in the last week or so is very interesting, because those signals are all reversing. So bonds have started rallying, as you've pointed out. The US dollar has also started rallying, which is very interesting. And if you look across the currency markets, the Aussie dollar yen, as an example, has broken down. So that's the ultimate reflation signal, the Aussie dollar yen. And so bond and currency markets are suggesting we're seeing, mid-cycle pause in that reflation trade. Now, the equity piece hasn't quite fallen into place yet, because we haven't seen the correction that you'd expect to have in risk assets when those safety assets start to rally.
Okay, Justin, we'll get to the equity markets in a second, because that's what we're all very interested in. But what are you saying, that it's not transitory, we're just having a pause, or is inflation under control as reflected in those 10-year yield bonds, which are the longer dated ones?
So what we're seeing is what we see, midway through most cycles. We're seeing a correction in the reflation trade. The dollar's rallying, the bonds are rallying, and equities should correct. That'll go on for a couple of months, and then the primary trend will return, which is again this reflation trade. Bonds will sell off, the dollar will sell off, and equities will move back to a strong advance until the cycle completes, probably next year.
Okay, Ben, let's bring you in here. Do you agree with that, or are bond yields going to stay down, and this isn't a mid-cycle correction in this reflation trade?
Well, if you look at last year, the million-dollar question everyone was asking is, why are equity markets so strong when the news was so grim? And ultimately, the market could see the economic growth that was coming. It just wasn't evident at that stage. And you fast forward to today, and you can see we are in a very strong economy. To me, it doesn't sort of line up where rates are versus the GDP growth or the pretty sort of exuberant conditions. So I think we will see central banks move faster than expected, but I still think that the structural drivers of long-term inflation are there, sort of aging populations, technology, all these sort of things that we talk about. And I don't believe it's going to go beyond, into the next sort of zone, which is effectively what bond markets are pricing in at the moment.
So transitory in your eyes, which sets up a nice juxtaposition between you two. So Ben, sticking with you, how do you get your portfolio ready? What do we do? Because lower yields on the 10-year has told us stick with long-term growth stories and get away from those cyclicals that depend on the economy.
Yeah, and then you've got all the COVID sort of issues that have been created, windfalls for some companies, headaches for others. Our view, like our turnover typically is quite low across our portfolio, and it's really about finding what we think are great businesses and sticking with them, despite all the short-term noise about inflation, interest rates, etc. I think one thing I would say that looks interesting to me are the structural growing businesses that have had the COVID hit over the 2021 financial year. There are businesses, I think, that have, it's easy to forget in Australia that the disruption that has been caused in America and Europe, particularly for businesses with big operating environments in those economies. So I think some companies are going to be cycling against weaker comps as they come into 21, 22. And they'll hopefully, sort of have this tailwind of people looking out for growth stocks again.
Okay, Justin, it feels like you're going to go the other way. Where do you position yourself in that reflation trade that you talked about if we're just having a pause? Is it in those long-term growth stories or in the more cyclical types names in the market?
Mm-hmm. Again, the dollar is actually a really important part of the puzzle here. What you find is the dollar follows very closely to growth in base money in the US. So you had this explosion in base money growth last year and the dollar deflated. That's stopped now and is starting to normalize. That's allowing the dollar to breathe and to recover. And that's what you're starting to see now. So the dollar's rallying. That's the key signal for an unwind of this reflation trade. And the defensive sectors, I think, will outperform in the next couple of months as these markets correct. And then, the reflation trade will resume again in the fourth quarter of the year. So sell those reflation sectors. I mean, the obvious one is the mining sector. That's the pointy end. As the dollar rallies, it's very hard to see those commodity names performing. So I think they will struggle in the months ahead. Similarly with the domestic cyclicals and energy and the banks also. Globally, the banks really struggle when bond yields increase. We've seen the US banks break down. The European banks have been under pressure. The Australian banks have been incredibly resilient, but I think their time will come in the weeks ahead. Then on the flip side of the coin, those bond proxies in telcos, in utilities and infrastructure, they've really been left behind in the last 12 months. So I think there's a nice catch-up rally for them.
Okay, so you want to be in utilities, long-dated type of assets that grow over time. Ben, what about you? Can you give us some names or sectors that you want to be positioned in over this period?
I just picking up on the last part of Justin's commentary there. I also agree. I think some infrastructure stocks have been really left behind. And as long as you don't believe we are going into a significantly changing interest rate environment, the yields on some of these things look quite appealing, particularly, I would say, for the assets that have had COVID issues again. So things like airports, some of the toll road operators, etc. I've copped it right between the eyes over the last couple of years. And the uncertainty about the reopening, I think, is creating quite a good buying opportunity in those names. On the growth side, for us, it's, those businesses that have had some direct disruption that we think are going to come out of it. You're going to see earnings accelerating against a weaker comparable. So, a few examples there. Aristocrat, as gaming operations start to really ramp up across America. ResMed, as the backlog of sleep patients start to be able to get in front of hospitals, and also the new device is rolled out. CSL, which has had major issues collecting blood across the south and southeast of America. So they're sort of the names that we're looking at. And they're all sort of, the trajectory of the recovery of their earnings looks different in each case. And, in some cases, I think the market's got sort of overly bearish, and other cases maybe a bit too bullish.
So you've given us a few names there. A lot of those have already run. They've been going since April, since that 10-year bond yield started to head backwards again.
Yeah.
Have they gone too far?
I don't think so, Matthew. I think, if you, in those examples, Aristocrat had a great result in May and really caught out, the CEO was about as bullish as I've heard him for some time. The digital business had a huge pull through during COVID. And then, he was sort of saying in Vegas, if you look at the occupancy rates on the Strip and the big 8 resorts, he said it's like New Year's Eve every weekend for the next 9 months. So they're really going to come back into a much better environment. ResMed's had this double win with Philips having to do a recall of its CPAP machine. They're launching theirs, and there's a backlog of patients. So and CSL is probably the one that looks the cheaper of those three. It's still got some catch up to do, I think. So we'll see how it plays out.
Justin, Ben's given us some names. You've given us some sectors. What's some names we can look at?
So again, in the growth part of the market, I mean, the GARP stocks should do quite well. You saw that in recent sessions offshore, Microsoft, Google, Amazon. These GARP names, that's the sweet spot for where we are. So I'd agree with Ben on some of the names he's mentioned. The healthcare names do look like they've run pretty hard. So again, if we see a correction, they'll probably participate in that. Some other growth names that I think are worth revisiting. A2 Milk, it's been knocked around a lot. The street's destroyed, 2022, 2023 estimates. I was looking at the 23 estimates earlier, the 30% of where they were 18 months ago. So I think there's plenty of scope for that business to surprise going forward. They've cleansed the supply chain. Pricing's coming back up on the cross-border e-commerce platforms. And so I think there's a nice recovery to come through there.
So we've got this environment, Justin. Bullish or bearish the market? Can we travel up given the environment?
Well, I think we're due this correction. You normally see one or two mid-cycle corrections. The dollar's the key. The fact that dollar's rallying is a real headwind for these risk assets. And so I think we see a correction in the months ahead.
Ben, same question to you. Are you a little bit on the correction side, or you think we just march upwards and onwards?
No, I'm on the correction side as well. I think it'd actually be healthy for the market, Matthew, like just a bit of a flushing out of some of the heat that's developing in the market. I guess if you take a longer term point of view, I kind of think we're still in the bull market that started in 2009, despite the COVID sort of big hit that we took. We are getting closer. The markets go in cycles. There is a bear market, I think, sort of coming in the next year or two, but we've probably still got some more to go. Doesn't feel like there's euphoria out there at this stage.
So there's a little bit of kryptonite around, but we reckon Superman, after a couple of months, will be able to avoid it and we can go for growth again. That was a ripper of a show. If you enjoyed it and you want to see more, why don't you subscribe to the Livewire YouTube channel?